and very good evening to this very respectable audience. So I'm sure everyone has this very important question in their mind today, which is what is happening to the futures market in the last 5, 6 sessions. So I'll start by giving some insights on that, since that will directly impact our opening prices in India. So you may have noticed that we about a week ago, the December futures in New York was around 89 cents, and today we are trading at 104. So this 15-cent increase in a week is not natural, and it shouldn't happen in the normal course of trading. But you've seen also the ZCE China futures up 15% in the last 5, 6 trading sessions. And I think it's kind of correlated to the China futures. You have a lot of Chinese speculators who have entered the US futures market. And there are some positive reports coming out in the relation between US and China, and this could be the reason why Chinese speculators have entered the market. Firstly, at 89 cents, the reason why the market corrected to that level was because of the Evergrande crisis, the real estate crisis in China. And everybody thought that this bubble is going to burst and there will be, credit defaults, etc., coming out of China in a very big way. But it seems in 2 days' time, Beijing announced that they will intervene in a certain way, and hence this problem has been pushed back by maybe a month or two for the moment. So that was the first turnaround sign. Second was the Huawei executive, one Mrs. Meng Wanzhou. She was released from Canada, and some Canadian executives of various companies were released by China. And hence, this will definitely improve the US-China relations in the near term. And you've already seen this because China has started procuring US cotton on a weekly basis in a large scale. This was the first point why the futures turned around from 89. Secondly, there was very heavy shorts done, because of Evergrande, and then because of this news, they had to come in for immediate short coverage. Also had mill fixations, mills in Pakistan, Korea, Bangladesh, not so much in India, but many other countries around the world, they buy cotton on call, means they fix the basis on the futures market. It's just a fixed basis on the contract, but they have not covered the futures. So they look for opportunities when future falls, and then they try and book the final price by fixing it. So there were a lot of mill fixations to be made. And when this turnaround happened, everybody came in to fix their positions in a panic. So that further fueled the upside. And if you see there is enough cotton available for first quarter of next year, there is no real panic, for this sudden meteoric rise. You can probably see that because December futures today is above 104 cents, but July futures 2022 is still around 99. So there is a 5 cents inverse between December and July, which gives you an idea that there is enough cotton available in the first quarter, beginning Jan, Feb, March. At the present time, until December, there seems to be an issue. And the issue is that the mills on average around the world are probably covered 45 to 60 days. Some are even covered lower than that. And hence they will all come in to buy, all kinds of cotton from medium staple to ELS until December. And you may not see your Indian prices go down until December. That is quite certain, looking at the coverage of the mills. Now, lastly, we have already crossed 100 cents on futures. We are at 104. I was a bit surprised. I thought this rally would probably halt around $1, but it has crossed $1. So now we are in a new territory. And the next resistance level is 105. If we cross 105, then you are probably looking at 110. That is the next on the charts. So let's hope that it doesn't go one way. I mean, we all want stability so that the yarn market also stabilizes, or and remains at a higher level. So we don't want a sudden collapse either. At the moment, around 98, 99 would be the support, and 105 would be the ceiling. That is where we are trading just now. So this is where I've started off with the futures market, Mr. Prabhu. Do you want me to still add just now, or should I take a pause?
Sir, you can complete whatever you want to tell.
So then, shall I now speak about how the Indian pricing can work in the export market for everyone's understanding?
Yes.
Since we spoke about the futures market. So at 104 on December, today, let's say a mill in Bangladesh wants to buy Indian cotton, or let's say it wants to buy cotton for 40s to 60s, which will be about 30 with a higher strength. Now 30 plus 31 cotton, they would probably have to buy only in India, because they will not get any other cotton like Telangana from any other part of the world at today's level. If you if you consider Telangana 31 today around 57.5, I think that's also a low price. Let's say 58,000 spot. And with the ocean freights, the ocean freight last year to Chittagong was $1,200 for 140 foot. This year it is $3,200 for 140 foot. So it's about 3 cents higher only in ocean freight. Okay, so let's come back to 58,000 plus 3,000 rupees would be the minimum cost this year. That's 61,000 divided by 74, divide 784. It would be around 105 cents today. CNF Chittagong for a mill in Bangladesh, they would buy it day and night at this price. Because if the futures is at 104, they are getting that cotton at 100 on the futures, which is very cheap. Today, if you look at West African basis, it is a minimum of 10 to 11 cents on. So your cotton is trading today at 10 cents below any other replacement around the world. I don't expect, for 30 plus cotton prices to come down. Not before January. That is for sure. Then coming back to, let us say, your bread and butter Bunny from Maharashtra and Shankar 6. These also are traded at similar levels internationally. They are both considered at par. I mean, you have seen the good grades coming out of Maharashtra in the last few years. So they are both at par. And this would probably go at a discount of 2 to 3 cents compared to your Telangana. So 56.5 is where I would put my level at as a basis today for these two cottons. And if the futures market goes up further from here, then you may see an increase beyond these levels. If the futures market comes down 5 cents from these levels, you will accordingly see an adjustment. But these kind of levels, plus minus 1,000 rupees is where we will be at till December. So that's as far as Indian cotton is concerned on the medium staple side. And now I'll quickly talk about the long staple, where there is a bigger issue this year, because the US PIMA situation is very different than what it was in the past. And due to the lack of water in California and lower plantings to PIMA, this year's PIMA incoming crop is only 3.5 lakh bales, which is rather short crop. If you look at the last 10-year average, it's always been around 5.25 to 5.5 lakh bales. Also, the carryover from this year to next season is only about anything between 50,000 to 75,000 bales. So let's say 75,000 plus 3.5, that's 4.25 total availability of US PIMA, of which 1.9 lakh bales have already been committed. So we are left with only another 2.5 lakh bales, let's say approximately, left to be sold. and the entire season is still ahead of us. On the other hand, Egyptian Giza 94, which is a replacement of DCH and also Pima, which has been heavily bought by Indian mills last year, is about 80,000 tons this year's crop. Last year's was only about 45,000 tons, but the carryover from the previous season last year was 25,000. So last year total availability of Giza 94 was 70,000 tons. This year is 80,000. The farmers in Egypt this year have become very greedy, and in the local auctions there, they have released prices, opening prices of between 230 to 235 FOB Alexandria. So that equates to about 245 Tuticorin today. And the Pima is being quoted at 270 Tuticorin today. And if you convert DCH at 115,000, means 1,15,000, mill delivered, you add expense of maybe 1,000-1,200 rupees, it still comes to around 199 to 200 cents a pound, which is also very, very high for DCH. We've never seen these levels before. It's new territory for me at least. But looking at the Pima and Egyptian situation, it seems it's a fair price for DCH, you know. And the fine count markets also hundreds above are doing quite well. So if the demand continues for these yarns, then these prices can sustain on ELS. That is my opinion, because of the short crops. You don't have any other crops really. You have Indian DCH. DCH also this year they are saying maybe 50,000 bales lower than last year. That is a possibility. Pima is already lower. Egyptian is a bigger crop, yes, but the farmers are holding back at the moment. And then you have very small crops like Israel Pima. You have some cotton grown in Spain, Greece, which is negligible. You have Turkmenistan ELS, which the president of Turkmenistan is not releasing yet. And yes, there is the Chinese ELS, but that is again a different story. We don't know what is happening inside China, because they always keep it a very close secret. And what we have found out is that this year's ELS crop in China is about 55,000 tons against a normal crop of 1 lakh tons in China. So even China is facing an issue on ELS this year. They are not going to export any of their cotton. In fact, they will also come in to buy ELS. They will be a net importer for fine count cottons. So the ELS situation is looking very remote to me. If anybody is looking at lower prices for later on in the season, it might happen. I mean, you might see a correction of 10-15 cents, but at the moment it looks difficult.
Essentially, my focus today would be on the price risk of cotton. That's going to be my gist of the presentation, which I'm going to show also. I see that many organizations in India which are exposed to this price risk don't take it that seriously, simply because these things come and go, and we have a short memory. We forget about price surges that happen from time to time. There is no real seriousness about managing this price risk because things have changed. One has to understand that things have changed over time. It's not just the demand, supply, and the fundamental numbers that drive prices anymore. There is a lot of other new factors that come into play. A lot of external factors apart from demand, supply that come into play. Being conventionally doing business only based on demand supply is not going to help anymore. You need to understand that the tail is wagging the dog. It's not the dog wagging the tail, because the cash markets used to give direction for futures. Now it's exactly the opposite. It's the futures market which is now giving direction for the cash markets. So it's very, very important to understand what is happening in the external markets also. That includes what the funds are doing, because these are funds with huge amount of money at their disposal, and they trade in many of these commodities purely for direction, purely for momentum, and once they make the money, they're going to walk out comfortably. And in that scenario, your business is at risk because they tend to move the markets in a big way, especially if you look at the current scenario. Now, cotton has been struggling around 94, 95 cents for the last 11 years now. If people have been observing the prices very closely in ICE, you would have noticed that it's been struggling at 94, 95. At least 7 to 8 times it went and tested that. Now, if one were following the prices very closely using various techniques like technical analysis, you could have easily forecasted or easily understood that this time around it's going to break out, because all the fundamentals are in favor at this point in time. You have weather situation, you have shipping and logistics issues that are going on globally. So all this is just going to drive prices in a much bigger range at this point. After a 10-year kind of gap, it's breaking out of this range. It's like a dog tied up, when you leave it after a long time, it's just going to run away like anything. So that's exactly what's happening in cotton at this point in time. And putting a number to where this will go and end is anyone's guess. But technically 1.15 or 1.20 is where the international prices are going to be inclined to test, at least. I'm not saying that it will test those levels, but definitely there will be an inclination to test those levels. So with that, I just want to again emphasize on managing this price risk efficiently, because raw material price risk is the most important element in your P&L. Most of the companies in exports and spinning, I think this aspect, what I have noticed so far, there are people who are starting to take it seriously, but so far, they just leave it to the market to decide. So that should change going forward. And one of the things that will help most of you all manage price risk is focus on something called technical analysis. Technical analysis is purely understanding markets using the price behavior. See, it's very important to understand why you need to use technical analysis. I'm setting the floor so that when I present some of my slides, you will understand why it is important to look at techniques like technical analysis to help you manage price risk, especially cotton price risk. Now, why price behavior is important is because all the factors that affect cotton markets, the gentleman Devan Shahji spoke very clearly about all these factors. I think he made a beautiful overview about what's going on right now and what is expected. So all the fundamental factors are basically factored into one variable called the price. Now, if we are able to understand that, and if you are able to follow the price very closely, it will give you many, many signals. Now, one of the key signals that I got in the month of March, when prices were near 75, 80, was that this is not going to stop here. It's going to break out and possibly go above $1 very clearly. And I had put it out in my report in Cotton Association of India also. I'm going to show that those slides I'm going to show. Basically, by looking at the price action. See, what happens is in every market, you will have some big players and you will have some medium-sized players and you'll have some small players. Now, what these big players are up to can only be seen in the price, because they will be privy to certain information which the entire market is not. But when they have that information, first what they do is they go and do something in the price, which means they either go buy or sell. So that is impacted in the price. So one who is following the price very closely can understand that quickly. And based on your experience of using technical analysis, you will be able to forecast prices fairly reasonably. Technical analysis is used across asset classes. It's not just in commodities, but it began in commodities. It's the Japanese rice market which started this technique called technical analysis. They understood that it's not just the factors, it's the price itself that gives you many signals to understand. So price forecasting can be successfully done using technical analysis. So my only urge to all of you is please start using technical analysis to forecast prices apart from just pure demand supply fundamentals, which you all have been following for a long time. Because many of these funds who trade in these markets, they don't look at fundamentals much. They purely look at the price direction and they bet on the price direction. So for that, they use technical analysis largely. So that is affecting your business, and therefore, please start using technical analysis as much as possible. In fact, I would urge my next speaker, Mahesh Shardaji, because he has seen many of my columns, and he's been reading many of my columns that I put out in Cotton Association of India. And I would request him when his chance comes to speak to just say a few words and how this technique has been so useful in forecasting prices, which has helped many players in India. So can I please open the slides? Is it okay if I open the slides, Professor?
Yes, sir, please.
See, this is in the month of March 2021. And this is exactly what I hope you all can read, can see what it is. Or do I need to expand it a little bit more?
If possible. Okay, now it's better.
Okay.
It's
So,
perfect.
Yeah, you can see a blue color arrow. Now, this is in the month of March, where I was talking about the price taking a shy at 98 cents or all the way up to $1. This is in the month of March. Now, move to June. The same arrow which you're seeing here. This is the indication that was there. Once it breaks 96 cents, then it will go all the way to 2011 high of $1.15, because that's the previous high that it made around that time. In fact, it went much higher than that. But this was in the month of June. Now, in the month of August, again, I continued to maintain this 2011 high of $1.15. Now, this latest issue of in September, it's the same thing. I've been maintaining this $1.15 for at least 4 to 5 months, and there are people who benefited by buying raw material. It's not just about taking advantage of price direction. It also helps in purchase policy of many of these organizations I work with. So once they understood that this is the potential for prices to rise, maybe fundamentally they were not convinced, because at that point in time fundamentals were different. But many of them did take advantage of it, and they've covered enough at least till December or early into 2022 first quarter. So this is basically to show to you that this particular technique is used a lot in predicting and forecasting prices. Not that it will be right all the time, but when you have such big moves, it's fairly easily predictable using technical analysis. And it is very important that you all start using this and get benefit by understanding the price direction much better. And fundamentals will also give a lot of direction and will add to it. But understanding price direction is the most important thing. So having said that, this is potentially where we're headed to, is around $1.15 or $1.20. And if the situation becomes worse on the weather side, on the logistics side, maybe it could even cross $1.20 and go to 130 or 35 thereabouts, which is an extreme situation. But at this point in time, where we are headed is towards $1.15 or $1.20. That's going to be a near-term peak for ICE futures. And the domestic markets, very likely that MCX cotton futures is going to test around 30,000 at least. That's going to be the minimum price range where we're headed to. If you look at the domestic demand, it's been absolutely fantastic. And the lockdown restrictions are slowly coming down. And then the export markets are extremely good. And I think spinning companies are benefiting with this rise in both cotton and yarn prices. And apparel exports, I think, are facing a lot of logistics and shipment issues. So fundamentally, all this is only clearly, pointing towards prices rising further. Yes, there is going to be arrival pressure very soon in the coming months. But before that, I think prices will make a very sharp up move. And if one has been covered well for the near term, then you're okay. But if you're not, then you're in for trouble. So with that, I'll pass it back to Prabhu sir.
A very good evening to all the listeners of ITF. I thank ITF for inviting me to speak today. My previous speakers, Deven Bhai, my senior and very learned in international trade, and Ganesh Shankarji, I congratulate them for giving such valuable information. Before I start my presentation, I would like to speak what Ganesh Shankarji had just said. His technical analysis is really valuable, but that valuable can only be gained if we pay for it. Actually, free advice is not valuable. It comes every fortnightly in our magazine. We just read it and leave it. So my humble suggestion is you have a small subscription to him and then take the valuable experience. Then only you will value that advice. Now, before starting, I would read one line: world before COVID and after COVID. As our Prime Minister said, though the countries are becoming inverted due to COVID threat, but still the markets are still not in isolation. They tend to all converge with the international markets. Secondly, uh, it's a very simple saying: futures are the indicators to what will happen in a few days to come. They affect highly the physical markets. What I would like to focus on today is to give you an overall scenario of the Indian situation. Friends, the Indian market, Indian cotton sowing was about 5 to 7% less than the previous year, but the crop was standing very good. We were all expecting it to do very well. Then past about 10 days, we had a bad weather. These unexpected cyclonic rains have disturbed pockets of cotton, and to gauge into the exact damage, we would still need another 10-15 days once the monsoon recedes. But to give you a view what is the current situation, in North India, we had heavy rains and about 25% of Haryana crop got disturbed and about 10% of the Rajasthan crop got disturbed. In a totality, if I would say, there are about 65 lakh bales which were produced last year, out of which we can say we are heading towards around 55 lakh bales this year. So we are having a shortfall of 20 lakh bales in North India, and the cotton has started arriving, but still it is raining in pockets. I feel by Navratras, the things will be better. Second thing, if we come to the central pocket, in central pocket, there have been rain damages in Khandesh area in Maharashtra mainly. Rest whole of Maharashtra looks fine, and little bit of areas in Junagadh, Amreli side in Gujarat. But overall, the central picture looks to be stable. We will achieve the last year's figures. If there is some current damage in current crop, it will cover up with further. As the rains have happened, there's a lot of moisture in the soil, so that will cover up. And as far as southern side is concerned, it is still safe. So if we conclude the total picture, with the 5% or 6% less area, a 10% down crop, which we were expecting around 350, 360 lakh bales, we could end up 325, 330 lakh bales. And we have to see how much it can cover up. This is one thing. So crop is on a tight position. It is going to, because our consumption has also increased. Second thing I would like to say is the overall demand for cotton is supported by many factors now. If we were to discuss the factors, All the mills have made good profits. They are having funds. Secondly, farmers are also having increased liquidity. They tend not to sell if they see the market rising. Plus, the trade has also gained. So there are three key factors financially which are going to support the market. Apart from this, the international market trend is also very, very firm. And the weather positions in US as well as in China are also yet to be observed for some periods. The overall tendency is strong. As far as another thing which we need to observe is the stock to use ratio, which has been decreasing. If we talk of 1920, 2021, 21, 22, we are lowering our stock to use ratio. That indicates our consumption is increasing, and next year we'll again have a more tighter stock to use ratio. There is good yarn demand. So what we are advising our associates is to not to panic by seeing ice. As Ganesh Shankarji said, ice is bound to move upward. And today I was reading a circulation which said the past level it can challenge 137. He had sent a picture. I think I will share it with Damodaranji. He can share it with you all. But now the only thing what we are left with is we are all covered till November. We need to wait till the peak arrivals come. But those levels of last year's or few years are not going to come. Whenever we take a buying decision, please see the technicals. Please observe where you stand towards export parity. If you are near to export parity, it's a good buy. Don't worry about it. And when there is peak arrival in December, then you take a call when and how much you should go long. This is one suggestion which we've been sharing with all our associates. Apart from this, there is strong buying demand for November, December, around 57 to 58,000 by local merchants and international Bangladesh mills. So we can see the markets is not going to fall till we have very high arrival. Any long position to be derived by the group should be done in the month of December to January. And till that, you should buy the minimum quantity which is required. This is my suggestion. As Devan Bhai said, the ELS book is very, very tight. Since most of the southern mills, ELS is consumed in south, we would advise you to book your ELS in 2 or 3 trenches and as soon as possible. With this, I would like to conclude. If anything is required, I can answer.